Hi, and welcome to our multifamily real estate investing webinar. Today, what we're going to be covering is the four jobs of your investment portfolio, and really, what your money should be doing for you. The four main reasons why I really feel you should be investing in alternative investments and not just the stock market. We're also going to cover the three main benefits of investing passively in real estate, but more specifically, why we love apartment investing. I'm also going to show you a little bit more about the mechanics of apartment investing, and that's how we increase the value of apartment housing while mitigating the key risks, and then also how investing in apartments can accelerate your wealth and reduce what you pay in taxes. So before I get into that, I want to share a little bit with you about our experience and our track record. So my partners and I, over time, have been able to acquire multiple properties across multiple states. And if you take a look here, what you'll notice, these are not small apartment complexes. These are large apartment complexes that are professionally managed. And as you can see, we have some experience doing this. You'll also see, if you take a look, you'll see the example hold times where some of them we've held for as little as 18 months and some of them the 4 or 5 year range. And then you can see some typical return on investment. Had you invested in any of those deals in the past? And very quickly, you can see that oftentimes these investments outperform, I'm sure, what you already have in the stock market. So a little bit more about me. My name is Stephen Lee Thomas, and I am a multifamily investor. I'm a business coach, I'm an entrepreneur, and I'm also a webcast host. But it wasn't always like that. My investing journey really started out, I was working in my corporate career, and my wife and I were making really good money, and we wanted to put it someplace. So we had this crazy idea of getting into a fixer-upper. So we bought this house. It was nearly 100 years old. Started working on it, and the project took way longer than we expected. Had to move in with my in-laws. My son was 2.5, I think, at the time. My wife was pregnant with my daughter. Things were chaotic. We ended up moving into this house before the construction was done, and it was just crazy. It was not the greatest experience. And then my daughter was born, but we still wanted to pursue this real estate investing dream. And but I was just so busy focusing on my corporate career and trying to balance my family and do this real estate investing. It was just simply overwhelming, and that's when I came across passive investing in real estate. And a long story short, that's how I was able to essentially get mailbox money. These investments would make money for me while I was changing diapers. So that's just a quick story about me and where I started and how I ended up in real estate and apartment investing specifically. So I'm going to share with you a lot of the things I've learned along the way to help you make the best investment decision for you. Okay, so the very first thing I think we need to agree on here is your investment portfolio, your retirement funds, they really need to be working for you. And so the way I see it is there's four jobs of your investment portfolio. Job number one is going to be to protect your income from inflation. Job number two is you're looking for long-term growth with your investments. That's why we do this, so that someday we can retire and have time freedom and financial freedom. Job number three, we want to protect the purchasing power of our money, and that's similar to protecting it from inflation. But we want to be able to, in the future, have enough money that we can buy things and the value of our money hasn't depreciated. And then really job number four is to reduce risk or hedging. And so the next slide, what you'll see is I want to introduce you just to this idea of alternative investments. And what are alternative investments? It's basically not invested in the stock market, which is where most of us have learned to put our money. We'll talk more about that later, but one of the interesting things about investing in the stock market is you're taught to invest your money with someone that you really don't know, but it's just the only thing that you've been taught to do. Whereas what I'm going to share with you is, as you invest in apartments, if you make that decision, you'll actually be able to build a relationship with the person who's owning and operating the property. So the big difference here with these alternative investments a lot of times is you get to meet that person who is overseeing the investment strategies as opposed to the stock market. you're really just giving your money to some large investment firm. You don't know who it is, and you're hoping they make the right decisions, based on your investment criteria. So why alternative investments? Number one is if we do alternative investments, we get that money out of the stock market, then there's a very low or even no correlation with the stock market. And by doing that, we really decrease the volatility factor that happens with those investments. So think of it this way: if Elon Musk does a tweet, or I guess it's X now, the stock market could react, up or down a certain way. Or even the recent election, we'll see all of a sudden the stock market goes up, but it could have been the other way and it could have gone down. And all of a sudden, what happens to all that money? So alternative investments are not that volatile typically. And then the other one is they typically have much better returns than the stock market. And we'll look at some of those examples here in just a few minutes. So on the topic of alternative investments, let's look at what some common examples are. And the first one is real estate. We're going to spend more time talking about that today. There's hedge funds, there's private equity, there's venture capital, there's oil and gas, there's fine art, there's crypto, there's collectibles. It's not on here, but there's precious metals. There's a lot of things that are alternative investments. One of the biggest problems is most of us don't know how to get into alternative investments. So what I've done is I've done quite a bit of research here and looked at where is the best place I can put my money for me and my family to grow it, decrease the volatility there, and remove that correlation with the stock market where possible. I'm not saying take all your money out of the stock market, but you'll see where it makes sense to diversify out of the stock market. So if we stack these alternative investments up side by side, what we'll see here, I took those correlations or those things we're looking for with our investments. So, protect your current income, looking for long-term growth, protect your purchasing power, risk reduction or hedging, tax benefits, and low to no correlation with the stock market. And when you stack all of these up against each other, one of the nice things about it is any of these will definitely help you with long-term growth. And you'll see that there's some advantages and disadvantages, but really there's one that just stands out above the rest, and that is real estate, because it can give you current income. If you make that investment, you get passive income, you get cash flow as part of that. It also helps with long-term growth. It helps with protecting your purchasing power. And one of the reasons why that happens is because when there is inflation, rent goes up. It is something that it just, when there's movement in inflation, there is movement in rent pricing. So it's got a lot of protection against inflation. There are some risk and we do our best to hedge, but really the only way to hedge is using a hedge fund. But you also get tax benefits, which you don't get in almost all of these other alternative investments. And also, like I said, you take your money out of the stock market, and so there's low to no correlation. And going back to that example of if there is presidential election, or if somebody makes a tweet, people still show up to their apartments and they still pay the rent regardless. They need a roof over their heads. So continuing on this, why do I really feel strongly that you should be considering alternative investments? And here's 4 reasons to consider, those investments and alternatives. And the first one here is to turbocharge your retirement savings. I'm going to show you an example here in the next few slides where you can really outpace what you've got as far as returns go in the stock market. And because of that, it boils down to you'll get to retire sooner and live off of the cash flow and get that time freedom you're looking for. It also makes it much easier to maintain your existing lifestyle during your retirement. A lot of people you hear that they have to take a pay cut when they go into retirement. And, I can't say this enough, but it adds diversification to your portfolio. So in preparation for this presentation, what I did is I did some research. Tiger 21 is one of them, but where I looked was here, Gemini World Wealth Report. I pulled some of the information there. And what I wanted to do is I wanted to see the really ultra wealthy people in this world. How do they invest their money? Are they doing the traditional investments like we're all taught to do in stocks and bonds, or are they investing other places? Well, let's take a look at how that's broken down. So they still definitely have some of their money in the stock market, but not all of it. They have some fixed income here. But where if you look at a lot of this, they have it in alternative investments. And so how do you break that down? Is you've got quite a bit of it in real estate, private equity. You've got some in hedge funds, commodities, and currencies. And so what that basically boils down to is a 25, 10, 53, that's stocks, bonds, and alternatives, where it's heavily invested in alternatives as opposed to just the standard what we're taught is the 60-40 split of stocks and bonds. So now what I've done is I've run two scenarios. I'm going to compare side by side apartment investing versus if you just left your money in the stock market. So in this particular example, what I want to show you here, there's two lines. There's a light blue and there's a dark blue. And the dark blue represents if you invested in the stock market, and the light blue is if you invested in apartments. So this assumes that's a 20-year investment. And if you took $250,000 and you invested it and you just put it in there and you didn't add anything else to it, you didn't take anything out, what would that growth look like over the next 20 years? So what this assumes is that the stocks return 8% on average, which is pretty common. If you were to go look that up on Google historically, a pretty consistent average over time is going to be close to 8%. And then apartments, it's actually very common when we underwrite deals is to target between 80 and 100% return on investment every 5 years. And so I basically just kind of split that down the middle. And so you got it's probably a little bit over 80% return on investment over the course of 5 years. And so that's where you can see, pretty quickly is there's where your big advantage is. They just perform better. Also, if you were to try to go for a cash flow play here on your investment stocks, there's no cash flow. In order to get money out of stocks, you have to sell your stocks. Whereas if you invest in apartments, a lot of times the average cash flow component here is 8%, somewhere probably between 6 and 8%. And so if you were to, you see this chart here, if you invested $250,000 and just left it alone for 20 years, at the end of that 20 years, your value of your stocks at an 8% growth over time would be $1.17 million. And if you had invested in apartments, the value of that portfolio would be actually worth $3 million. And so now we're getting much closer to that retirement number that you would be targeting if you wanted to live the lifestyle that you've been living and live off the cash flow. Okay, so now what I did in this next slide is I just bumped up the numbers a little bit, and I just pushed the stocks about as comfortable as I would be, which is it's the same scenario, $250,000 invested, left for 20 years, don't take any withdrawals, no additional funding. And let's say the stocks performed really good for the next 20 years at 10%. And the apartments, we were able to hit closer to that 100% return on investment every 5 years, which is pretty realistic. That gets you 20% average annualized returns, which is pretty amazing. Not to mention the tax benefits there. Once again, your stocks are not going to be paying you out any cash flow, whereas the apartments, if you had that money invested, you could be getting this 8% cash flow component. Now your stocks, it went up a little bit, but your apartment investment, now it's worth $4 million, and that's with a one-time investment of $250,000. So I think pretty quickly you're starting to see why not only invest in alternative investments, because your returns are going to be much better. They're going to outperform the stock market here. But, when you look at real estate and all the benefits that it has, and more specifically multifamily, because there's a lot of diversification in multifamily in and of itself, it's a very strong candidate for an alternative investment. So why real estate? Well, one, we just talked about this, is the cash flow component. You don't have to sell, stocks to get any cash flow. You don't have to sell a unit out of an apartment complex to get cash flow. It's just part of it. People show up, they pay rent, you pay your bills, and whatever's left over, that's cash flow. And then you also get appreciation. It just is something that happens. We all know this with real estate. You buy a house, you own it long enough, it gets more valuable over time. And I'll show you later how we force appreciation on these apartment complexes. And then lastly here is you get a pretty decent tax deduction. And at a very high level, the way this works is because you're buying real estate and a business, you get to take advantage of depreciation. And because you're a passive investor, you're a part owner, you get to take part of that depreciation and use it to offset your gains. And that really is how the tax advantages work. And most of these other investments don't have that value added into the asset class. Okay, but I mentioned this before. Is when I started, I actually did passive investing in apartments. I had tried the fix and flip an old house. I was chasing contractors. There was just so much work to be done. It was very difficult to do. It was a lot of work. I bought myself a job. It was not what I thought it was going to be. So why invest passively in real estate? Well, no tenants, no toilets, no termites. It just makes life a lot easier, and you get to all the advantages of being a real estate investor. So what is our investment strategy? Well, we buy and breathe new life into apartments located in primary and secondary markets across the United States. So how does apartment investing work? Well, there's really, a few things that we do here in apartments to create that value and give that back to the passive investors. And so the first thing is we buy and improve properties. We purchase these properties, we underwrite them, we know there's potential, we improve them, we improve the value, and then we're able to sell those and make money. At the same time we do that, we're able to generate cash flow. And that's, like I said, it's tenants pay rent. And if they're paying rent every month and you know what your expenses are, then what's left of that turns into cash flow. And by improving the overall quality of the apartment and improving the revenue collected, you just, force appreciation into that property. But why specifically do we like apartments as opposed to single family homes or Airbnbs or some other aspect of real estate? Well, the reality of it is there is a high and very consistent rental demand. There is a housing shortage in the United States, and there is a huge affordability gap, which means the cost of owning a home and paying the mortgage versus rent is somewhere around $1,200 to $1,500 per month on average. And with the cost of housing going up, there's just more and more affordability gap. And so there's just more people need to move into apartments. Also, it's a reliable income, and there's lease renewals. You know that there's going to be people renewing leases. It's pretty predictable outcome when you start looking at the numbers there. There's also the potential for higher rent yields. And what that means is a lot of the properties that we target, we know where the market rent is. And so if we can go and buy a property where the rents are a little below market, then we can increase those rents, or also we can improve the property overall, which improves the value of the property, which means you can also increase rents. And like I mentioned earlier, if there's inflation, then those rents go up right alongside of inflation. So I'm going to dive into each of these topics a little bit more. The reality of it is there's just a growing population, and as a result, there's housing needs. There's just more and more people in this country, and there is a shortage of housing. There's also the fact that there's a lot of people now who they prefer to rent because it gives them more flexibility. They can, at the end of a year, they can move, they can change jobs, they can change locations. It gives them more flexibility. So that also adds to the demand. And then, like I mentioned, it's just that housing for apartments is just much more affordable than it is for buying and owning a home. And, once again, diving down into, this reliable income and lease renewals, what that does is it gives us, steady cash flow. We know every month what the incoming rent is going to be. And when you're maintaining a property and you're doing good things to it, people want to stay there. And so you know that every year, every unit is going to come up for renewal. And if we can get half or more of those people to stay in there, then it becomes very predictable at that point. Which brings me to the last point. It creates actually a very predictable income. We spend a lot of time underwriting these deals, and we figure out what are the things we can do to add value and what can we do to control expenses. So the next point here is potential for a higher yield. And we know that we can go in and add value to these properties. There's specific things we've learned we can do to improve the property and make it a safer, more enjoyable environment for families. And the reality of it is they're willing to pay more for that because they have a higher quality of living. There's also this great thing that I love about apartment complexes as opposed to single family homes is there's this economies of scale. So if I was to go buy 100 single family homes, that means I've got, at least 100 different toilets. I've got 100 different showers. I've got so many things that are just different from one property to the next, and they're not all right next to each other. Whereas if I go buy a 100-unit apartment complex, I've got everything standardized, and I can bring in property management, and they are there at the property, and I've got staff, maintenance staff who can be there. So the economies of scale are just tremendous when you get into these apartment complexes. And then you get the tax advantages I mentioned earlier. What happens here is you get to take advantage of depreciation. I mentioned that mortgage interest deductions, and there's other tax benefits. And so when you get your distributions and when you sell the property and you have the big capital gain event, you get to keep more of what you make. So you're probably thinking to yourself, hey, this is all well and good, Steven, but how do you guys go and find the right property so that you can do these exact things? Well, here is our criteria so that we are making sure we're always in the right market, in the right neighborhood, finding the right deals. We look specifically for landlord and business-friendly states. We look for areas or states where there's above average population growth. So where are people moving? We're going to invest there. We're not going to invest where people are moving away from. Above average affordability gap. I mentioned this. The cost of owning a home across the United States in general is $1,200 to $1,500 above what it is for your average rent. And so we target those areas. Primary and secondary markets, the reason why we do that is because we know there's people that are moving there. We also look for value add properties. That means we know we can go in and we can renovate units. We know we can go add private yards. We can have covered parking. We can do upgrades to the gym facilities. There's a lot of things we can do to add value to these properties. We look for apartment complexes that are 60 units or larger, and we go after B and C class properties. And if you don't know a lot about the different class properties, basically an A class is a brand new, shiny apartment complex that was recently built and is going to be the most rent. The reason why we don't do A class is as sexy as it is. When there are issues with the economy, some of the first apartments that get vacated are A class. And where do they go? They move into the nice stuff, but still not quite as new. And that's B class and then C class. And this is really your working class. This is your blue, some white collar, just hardworking people that will show up and pay their rent. And then we also focus on where there's strong local employment and economic growth. So we're looking for places where people are moving and where jobs are being created, landlord and business friendly states. All right, so what are some of our typical scenarios? There's 3 different ways and we like to find our deals. And so the first one is off-market deals that we get from brokers or other industry connections, either distressed or underperforming properties or owners that are looking to exit quickly. So what is our investment process overview? What we do is we locate these properties and then we conduct due diligence. Basically, we go through and just like you would do a home inspection, we go through every single unit, every unit we can get into, and we go through a whole lot of detail and make sure that there's nothing hidden that's going to add a lot of expenses. Then we acquire the property and then we go in and we increase the occupancy and we reduce expenses. We run it. We own these things for 3 to 5 years, give you distributions along the way. Then we sell the property, return capital to the investors, and then give them a nice capital gain on the back end there. More specifically, what's our underwriting process? How do we make sure we find the right deals? So we are always searching for properties, and I mentioned, where do we get these deals from? But we find the deals, and then as a team, we start looking through these deals, and we figure out where it is we can increase the net operating income on these deals, and we build out what's called a pro forma. That's basically what is our forecast over the next 5 years, and that includes what are our expenses going to look like over the next 5 years, and what's our income going to look like over the next 5 years. Once we have all that, we look at it as a team, and we make a decision. Is this the right move for us or not? What do we think? Is it in the right neighborhood? Is it the right demographic? Are they going to be able to afford these improvements that we're making to this property? And from there, then we make an offer. And at that point, it's just an offer. It is not an accepted deal at that point. Once we get an offer accepted, then we do that property due diligence. This is where we show up with a team of people, and it may take 2, 3, 4 days to get through all of those units and check all the foundations and every single toilet and everything we can so that there's nothing hidden and we can have the right budget to go and make sure we can do all these improvements. And we also, while we're doing that, we check out the neighborhood, we check out the market. Are we going to be able to implement the business plan that we laid out? And then once again, we run that by the team and we say, is this the right thing for us to do? Is it a go or no go at that point? So let's talk about now about the value add process that we put into place. So as soon as we get a property, day one, we'll go in and we work with, I'm saying here, a strike team, but we work very closely with the property management company, and then we have our own asset management team who is on site. We create a comprehensive list of all the issues and the whole business plan of what we want to implement, and then we focus on reducing those expenses, driving occupancy, and then from there we can increase the rents. So what I want to do now is I want to show you, if you do those things, what are the different ways that it adds value to the apartment complex? How do we generate revenue at these properties? I've got a few different scenarios I'm going to show you. So the first one is, if we go in and we reduce expenses on the property, what does that do to the valuation? So what we're going to do is we're going to say our going in expense ratio, that's our income to expense, is 50%. Our current net operating income is $700,000. Our cap rate, this is essentially the value multiplier, if you will, of the deal. It's the NOI divided by the cap rate equals the value of the property. But let's say we purchase this for $10 million. If we decrease expenses to get that down to 42%, then we've added $112,000 in value or net operating income. And if you take that and divide it by 7%, then you increase the value of $1.6 million. And that's all we've done here is just decrease the expenses by $112,000. Okay, so that's just one part of the business plan. Now, let's say we go and we increase the occupancy. So we're assuming we're not changing the rental rates at all. We're just increasing the occupancy. So if we have something that's low occupancy and we can get it up to 90%, that's a 20% increase. We take your original net operating income and we add $77,000 of net operating income, factor in the cap rate, and now the future value is $11.1 million. So we've added $1.1 million there just by increasing the occupancy. So now if you squish that together and you have increased occupancy and reduced expenses, what does that do to the property? Well, we bought it for $10 million. All we did was decrease expenses and increase occupancy. We've added $2.9 million in value just by doing those two things alone, and we still haven't increased rental rates, which is part of our business plan. If we take that and then we also get to increase the rent, which is only 5% or 1%, year over year for 5 years, which is way below industry standard, which is about 2 to 3%. That adds another $1.5 million or so. So we take this $10 million property we bought, decrease the expenses, we increase the occupancy, and we are able to increase the rent. We just added $3.5 million in value. And so that's how we force appreciation on these properties. That's how we can underwrite them, and we can, with a level of certainty and confidence, execute our business plan. Now, all of that is all well and good, but once again, you might be thinking, well, that's good, Stephen, but there's got to be some risks there. Yes, absolutely there are. So I want to talk about those. There are market fluctuations. Markets go in cycles. And what's most important to understand about that is, we study these market cycles and they last on average 3 to 5 years. So when we are underwriting, we're always doing it 5 years. That way we can account for the market cycle. You also have tenants turnover and vacancy. That is something that happens. We're aware of that. And then the other thing that happens is you have unexpected maintenance and renovation costs. It happens. I mean, if you've ever owned a home, or even if you live in an apartment, there's unexpected things that happen. So how do we mitigate that? Well, a lot of it has to do with the deal criteria. For the first one, we basically look for markets where, even if there is an economic downturn, if people are moving to those areas and jobs are going to those areas, if there is a downturn in the economy, it's much more padded against that movement. Now, for the second one, how do we deal with the tenant turnover and vacancy? We are very involved with the property management company, and we only work with professional property management companies that are skilled in doing this and implementing these business plans. And we make sure that the tenants are happy. And if we do that, it keeps the residents in, and we have increased occupancy and low vacancy. And then, to the best of our ability to avoid those uncertain expenses, that's where we go back to that huge comprehensive checklist. We do the due diligence, where we go into every single unit that we can and look for all of those unexpected things that might come up. And so we budget for that accordingly. Now, what do we do after we've had the property? How do we get all the capital back to the investors and give them the good return that they're looking for? One of the exit strategies here is we do all the value add and then we sell the property and we make money off of it. Typically, like I said, we underwrite the deals for 5 years. If we can execute the business plan sooner than that, we will. And a typical business plan, it takes about 18 months, maybe 2 years to fully implement the business plan that allows for all the unit turnovers and the renovations to take place. Another possible strategy here is we refinance and we give people back their money or a big portion of their money and we hold on to it and then we get a whole bunch of cash flow on that property. Or if everything's really good and let's say we do the refinance and we can hold it long term for cash flow. So there are multiple exit strategies here. There's not like there's only one way to make money on this. There's multiple ways to exit these deals and have it be a good return for everyone. So, what makes us different? If you're out there looking at these other investment firms, well, we are experienced and we have hands-on management. We work very closely with our property management companies. We've been doing this for quite a while. We have strong broker and industry relationships. So we have brokers that will come to us and give us the best deals that come in front of them because they know that we're going to do everything we can to make everything right at the property. And then, as you can see, we have a very detailed process and we make data-driven decisions, not emotionally driven decisions, because when you invest emotionally, that's when you have problems. So we let the data do the talking on all of our investments. Now with that, what are the top 5 reasons why people invest with us? I'll go back to alternative investments. And you get to escape the volatility of the stock market. You get that stability. These investments will almost always outpace inflation. And what happens is you can drastically increase your ability to grow your retirement fund, your retirement portfolio, which leads to becoming financial freedom. And what we're all looking for is that time freedom and that ability to, retire and live comfortably just like we used to when we go into retirement. And so we don't have to take a pay cut when we go into retirement. And then a lot of people, you hand this over and you leave a legacy for your family. All right, so now that you've gone through all of this, what are the next steps here? Well, if you haven't already, I strongly encourage you to schedule a call with us. And what we're going to do on this call is we're going to have a conversation, look at you in a one-on-one conversation, and what would the investment scenarios look like for you? What investment strategy works best for you? I know we covered a lot of information here. I would strongly encourage you to prepare for our conversation. What are the questions that you have? Think about the amount of money that you might have to invest. What are your investment goals? What is the cash flow needs that you have? Are you only looking to do this, just invest and not take any cash flow? Maybe you have some retirement funds. And you want to do a self-directed IRA. Come with questions, come prepared. And at the end of it, what we're going to do is we're going to talk to you about where you're at currently with your investments, what's worked well for you, what you like about that, what hasn't worked for you, what your goals are, and really what's keeping you from hitting those goals. And at the end of it, you're going to decide if apartment investing is right for you. And if nothing else, you'll walk away with some great resources so that you can better plan for your retirement and your financial future. So with that, I'd just like to thank you for your time, and I look forward to seeing you on a call very soon. Thank you.